On March 11, 2010, court-appointed examiner Anton Valukas filed a report in the United States Bankruptcy Court for the Southern District of New York. It ran to more than 2,200 pages, the product of a year-long investigation into the largest bankruptcy in American history. Buried in Volume 3 was an internal Lehman Brothers email in which a senior officer described a particular accounting technique as basically window dressing. The record establishes something else about that technique. The transactions were executed through Lehman's London subsidiary because, according to the examiner's findings, no United States law firm would provide the legal opinion the accounting required. That last fact is the entry point. A firm headquartered in New York, regulated by the SEC, audited by a major accounting firm, moved tens of billions of dollars offshore. Not because the assets were offshore, because the legal opinion it needed to treat those transactions a particular way could not be obtained under American law. The question this episode answers is structural. What was the accounting treatment that required a foreign legal opinion? Why did that treatment let approximately $50 billion disappear from the balance sheet at the precise moment quarterly reports were prepared? And why did every gatekeeper in the verification chain fail to stop it? The mechanism has a name. Lehman called it Repo 105. To understand Repo 105, first understand an ordinary repo. A repurchase agreement is one of the oldest and most mundane instruments in short-term finance. A firm owns securities and needs cash. It sells those securities to a counterparty and simultaneously agrees to buy them back a short time later, typically the next day or within a few days, at a slightly higher price. The difference between the sale price and the repurchase price is, in economic substance, interest. The securities function as collateral. The firm gets cash now, returns it plus a fee later, and takes its securities back. This is not fraud, it is the plumbing of the modern financial system. Investment banks fund enormous portions of their balance sheets in the overnight and short-term repo markets every single day. The instrument is routine, liquid, and essential. Here is the critical point about accounting for a normal repo. The firm has agreed to buy the securities back. It retains all the economic exposure to those securities. So the accounting treats the transaction as what it is, a financing. The securities stay on the balance sheet. A liability appears alongside them, representing the obligation to repay the borrowed cash. Assets and liabilities both go up. The firm has borrowed money, and its books show that it has borrowed money. That is the baseline. A standard repo is a secured loan, recorded as a secured loan. Nothing leaves the balance sheet. Now, the distortion. The governing accounting standard at the time was Statement of Financial Accounting Standards number 140, SFAS 140, which addressed transfers of financial assets. Under that standard, a transfer of securities could be treated in one of two ways. It could be a financing. That is the normal repo treatment described a moment ago. Assets stay, liability added. Or if certain conditions were met, it could be treated as a true sale. A true sale is accounted for completely differently. In a sale, the securities leave the balance sheet entirely. They are gone. In their place, the firm records the cash it received. The condition turned on control. SFAS 140 examined whether the firm transferring the securities had surrendered control over them. One test for surrender of control involved the firm's ability to reacquire the assets. Here, the number that gives the technique its name enters the picture. A firm sold securities and agreed to repurchase them. but the securities it posted were worth substantially more than the cash it received. The accounting standard then treated the transaction as though the firm could not readily reclaim them, and therefore treated it as a true sale rather than a financing. The threshold Lehman used was 105%. In a Repo 105 transaction, Lehman transferred securities worth at least 105% of the cash it received. For fixed income securities, the number was 105. For certain equities, Lehman used a 108% threshold and called those Repo 108. The over-collateralization was the trigger. By posting $5 of securities for every $100 of cash, Lehman crossed the line SFS 140 drew between a financing and a sale. The economic substance was identical to a normal repo. Lehman was borrowing cash short-term against securities it fully intended to buy back, and did buy back, usually within days. The examiner's report is explicit on this point. The transactions were, in economic reality, ordinary financings. But because of the over-collateralization threshold, they qualified for sale accounting under the standard as applied. So consider what that permitted. In a normal repo, Lehman would record cash in and a liability. In a Repo 105, Lehman recorded the securities as sold, removed them from the balance sheet, took in the cash, and then used that cash to pay down other liabilities. Both assets and the corresponding liabilities shrank. The balance sheet got smaller, and a smaller balance sheet relative to equity means a lower leverage ratio. That is the entire purpose. Repo 105 was a mechanism for temporarily reducing reported leverage. The securities came back a few days later. The liability came back with them. The balance sheet reinflated. But if the transaction was executed just before the end of a reporting quarter and unwound just after, the snapshot the world saw, the quarter-end balance sheet in the public filing, showed the reduced figure. Now the architecture. How was this deployed in practice, step by step, as the examiner's report and the SEC record establish it? Step 1. The accounting opinion. Sale treatment under SFS 140 required a legal opinion confirming that the transfer of securities constituted a true sale. Meaning, if Lehman went bankrupt, the counterparty would actually own the securities, and Lehman's creditors could not claw them back. This is the true sale opinion. It's a standard requirement in structured finance. And here, the examiner made a finding that anchors the entire case. Lehman could not obtain a true sale opinion for these transactions under United States law. American counsel would not sign it. Under US law, these transactions did not look like true sales. They looked like financings, which is what they were. Step 2. The offshore execution. No US firm would provide the opinion. So Lehman executed the Repo 105 transactions through Lehman Brothers International Europe, its London-based subsidiary. There, the law firm Linklaters provided an opinion under English law that the transactions constituted true sales under the terms of the specific master agreement used. The examiner's report is careful here. The Linklaters' opinion was not found to be improper as a matter of English law. It addressed English law questions, and the examiner did not conclude it was wrong. The structural point is different. The transactions were routed to London specifically because the legal opinion required for the accounting could be obtained there and not in the United States. Step 3. The assets. United States securities held by Lehman entities were transferred to Lehman Brothers International Europe so they could be used in the London-based Repo 105 transactions. Even US inventory could be funneled into the mechanism by moving it to the entity where the true sale opinion held. Step 4. The timing. This is where window dressing becomes literal. Lehman's use of Repo 105 spiked at quarter end. The examiner found that Lehman would substantially increase its Repo 105 volume in the days approaching the close of a reporting period, removing securities from the balance sheet at precisely the moment the balance sheet was measured for public reporting. Then, in the opening days of the following quarter, Lehman would repurchase the securities, bringing them and their associated liabilities back onto the books. The examiner's report documents that the volume of these transactions at quarter end reached approximately $50 billion in the first and second quarters of 2008. $50 billion. Removed from the balance sheet at the reporting date, returned days later. The funding to repurchase the securities had to come from somewhere. It came from Lehman's ordinary liquidity. So the mechanism not only distorted leverage, it consumed real cash to unwind at a firm that in 2008 was under mounting liquidity strain. Step 5. The metric that mattered. Why $50 billion and why leverage? In 2008, the market's confidence in investment banks was measured heavily by their leverage ratios. Analysts, counterparties, and rating agencies watched net leverage as a proxy for how much risk a firm carried against its equity cushion. A firm reporting rising leverage in early 2008 was a firm the market would question. The examiner found that Lehman used Repo 105 specifically to reduce its reported net leverage at quarter end. The examiner quantified the effect. Repo 105 usage reduced Lehman's reported net leverage by approximately 1.7 to 1.9 points at the end of the first and second quarters of 2008. Those points were the difference between the leverage story Lehman told the market and the leverage the firm actually carried. The examiner's report contains the internal characterizations. A senior officer described the technique in an email as basically window dressing. Another internal communication referred to it as an accounting gimmick. The firm's global financial controller acknowledged, per the report, that the only purpose or motive for the transactions was reduction in the balance sheet, that there was no substantive difference between a Repo 105 transaction and an ordinary repo, and that the difference in accounting treatment was the entire point. Testimony gathered by the examiner established that senior figures knew the transactions had no purpose other than the balance sheet effect. So, assemble the org chart. At the center, Lehman Brothers Holdings, the New York parent, preparing the consolidated financial statements the public would see. Feeding into it, Lehman Brothers International Europe in London, the entity that could execute the transactions because English law counsel would sign the true sale opinion. Flowing between them, securities transferred from US entities to London to be used as Repo 105 collateral, providing the legal foundation, the Linklaters opinion under English law, providing the accounting rule that made it all work, SFAS 140, and its control-based test for sale versus financing, and governing the timing, the reporting calendar, with volumes spiking to roughly $50 billion at each quarter end and unwinding immediately after. That is the architecture. A financing dressed as a sale, executed offshore to obtain the opinion the accounting required, timed to the reporting date, sized at $50 billion deployed, to shave nearly 2 points off reported leverage. Now the detection failure. The gatekeepers missed this, or missed it long enough that it surfaced only in a bankruptcy examiner's report after the firm had already collapsed. Start with what the accounting rule permitted. SFAS 140 was a real standard. Its over-collateralization test was a real feature of that standard. The examiner did not conclude that Lehman had invented a fictional treatment. The technique operated in the space the accounting rule created. This is the first structural feature of the detection failure. When a firm exploits a genuine gap in an accounting standard, the ordinary gatekeeping process, oriented toward catching departures from the standard, is poorly positioned to catch conduct that follows the letter of the standard while defeating its purpose. Consider disclosure. A firm using repos is required to disclose material information about its financing activities. The examiner found that Lehman did not disclose its use of Repo 105 in its public filings. The transactions removed roughly $50 billion at quarter end, materially affecting a metric the market relied upon, and the mechanism was not disclosed. The examiner concluded there was sufficient evidence to support a claim that Lehman's failure to disclose the Repo 105 practice rendered its financial statements materially misleading. Without disclosure, the analysts and investors reading the filings had no way to know that the leverage figure they were evaluating had been reduced by a quarter-end maneuver that reversed days later. Now, the auditor. Lehman's independent auditor was Ernst Young. The examiner's report addresses the auditor's role at length. The report found that a senior Lehman officer, a firm vice president, raised concerns internally in 2008 about the Repo 105 practice and about the volume of the transactions, and that these concerns reached the auditor. The examiner found sufficient evidence to support a claim that Ernst Young was negligent in failing to investigate those allegations adequately and in connection with Lehman's failure to disclose the practice. Ernst Young stated that its audits complied with professional standards. The structural observation is this: the whistleblower's concern was raised, the mechanism was known internally, and the verification chain still did not produce disclosure. For the audit to have caught this earlier, the auditor would have had to treat the absence of a US true sale opinion and the deliberate offshore routing as a red flag about substance rather than a resolved technical matter. Consider the rating agencies and the analysts. Their evaluation of Lehman ran through the reported leverage ratio. That ratio was the output of the very balance sheet the Repo 105 transactions were manipulating. This is a circularity that recurs throughout financial fraud. The gatekeepers relied on a metric, and the metric was the thing being distorted. An analyst who trusted the reported net leverage figure had no independent window into the fact that the figure had been reduced by nearly 2 points through undisclosed quarter-end transactions. To have caught it, an analyst would have needed to notice the pattern of balance sheet contraction at quarter end followed by re-expansion. That pattern was visible only with access to intra-quarter balance sheet data the public filings did not provide. There is a deeper structural point about the timing. The transactions were unwound within days of quarter end, so the distortion was invisible in any snapshot taken at the reporting date. Financial reporting is built on snapshots. A balance sheet is a photograph of a single moment. Repo 105 exploited the difference between the photograph and the film. If you only ever see the firm at the instant the picture is taken and the firm arranges to look a particular way at that instant, the snapshot-based verification system cannot detect the arrangement. This is not a failure of any single gatekeeper's diligence. It is a limitation of point-in-time reporting itself, when the reporting date is known in advance and the entity can shape its condition for that date. Consider the regulators. Lehman in this period operated under the SEC's Consolidated Supervised Entity Program, a voluntary regime under which the major investment banks were supervised at the holding company level. The SEC monitored Lehman's leverage and liquidity, but the supervision relied substantially on the firm's own reported figures. When those figures were shaped by an undisclosed quarter-end mechanism, the supervisory picture inherited the distortion. For the regulator to have caught it, the regulator would have had to independently reconstruct the firm's intra-quarter balance sheet and identify the systematic contraction at the reporting date. That is a level of forensic reconstruction that ordinary prudential supervision, dependent on firm reporting, did not perform. Assemble the detection failure. The accounting rule genuinely permitted the treatment. The practice was not disclosed. The auditor did not force disclosure despite an internal concern reaching it. The analysts and agencies relied on the very metric being distorted, and the entire distortion lived in the gap between a point-in-time snapshot and the underlying reality across the quarter. Each is a structural weakness in the verification chain. They compounded. For detection to have occurred earlier, more than one of these links would have had to hold. None did. Now, the unraveling. What exposed Repo 105? The sequence is instructive because the mechanism was not exposed by any of the gatekeepers who were supposed to catch it in real time. It was exposed after the firm was already dead. Lehman Brothers Holdings filed for bankruptcy on September 15, 2008. It was and remains the largest bankruptcy filing in United States history, with assets recorded in the hundreds of billions. The filing did not mention Repo 105. The mechanism was not the announced cause of the collapse. Lehman failed because of its concentrated exposure to illiquid real estate and mortgage assets, a loss of counterparty confidence, and a liquidity run. Repo 105 was not the disease. It was, structurally, a symptom management technique that concealed part of the disease from the market. In the bankruptcy, the court appointed Anton Valukas, chairman of the law firm Jenner and Block, as examiner. His mandate was to investigate the causes of Lehman's failure and to identify potential claims the estate might pursue. This is a critical structural feature of how the fraud surfaced. A bankruptcy examiner has investigative powers and access that ordinary market participants and even ordinary regulators frequently lack. The examiner could compel documents, take testimony, and reconstruct the firm's internal records. It was this forensic access, deployed after the fact, that recovered the emails, the internal characterizations, and the transaction data that made Repo 105 visible. The examiner's investigation ran through 2009 and into 2010. It reviewed millions of documents and conducted extensive interviews. And on March 11, 2010, the report was filed. It ran to more than 2,200 pages across 9 volumes. Volume 3 laid out the Repo 105 findings. It established the mechanism, quantified the $50 billion quarter end, documented the internal characterizations, including window dressing and accounting gimmick, and set out the finding that no US law firm would provide the true sale opinion, which is why the transactions were executed through the London subsidiary under an English law opinion. The examiner reached a specific structural conclusion. He found that there was sufficient evidence to support the existence of colorable claims that certain officers breached their fiduciary duties by permitting and failing to disclose the Repo 105 practice, and that a colorable claim existed against Ernst Young in connection with its failure to investigate and its role regarding the non-disclosure. The word colorable is doing precise work. The examiner was not a court. His finding was that the evidence was sufficient to support a claim a plaintiff could plausibly bring, not a determination of liability. That distinction matters for how the record should be read. The report's publication was the moment the mechanism became public knowledge. It drove immediate attention to the accounting treatment and to the offshore structure. The specific detail that the transactions were routed to London because no US firm would sign the opinion became the defining fact. It demonstrated that the firm itself had, in effect, acknowledged that the treatment could not survive under American law. The mechanism collapsed the instant it was exposed because it depended entirely on being invisible. A quarter-end technique that removes $50 billion and reverses days later has no defense once disclosed. The disclosure is the defeat. The entire value of the maneuver was that no one knew it was happening. The regulatory and enforcement response followed. The SEC opened inquiries into the accounting practice and the disclosures. In the years that followed, Ernst Young resolved civil litigation brought by the New York Attorney General relating to the Lehman Repo 105 matter, agreeing to a payment without admitting wrongdoing. The public record on the enforcement side is more limited than the examiner's findings might suggest. This is itself a structural fact worth stating plainly. The examiner found colorable claims. The subsequent enforcement outcomes did not produce criminal convictions of individuals for the Repo 105 practice. The mechanism was exposed, characterized, and quantified in exhaustive detail by the examiner. But the translation of that examination into individual criminal liability did not occur. The record shows findings of sufficient evidence for civil claims and a private settlement, not a criminal adjudication of the accounting treatment. Consider why. The treatment operated within SFS 140. The offshore opinion was, by the examiner's own account, not improper under English law. The conduct lived in the space between what the accounting standard literally permitted and what honest reporting required. That space is exactly where fraud becomes difficult to prosecute, because the defense is that the rules were followed. The examiner's finding that the failure to disclose rendered the statements materially misleading was the strongest thread, and it ran to disclosure rather than to the underlying transactions themselves. This is a recurring pattern in accounting cases. The transaction may be defensible under a literal reading of the standard. The failure to tell investors it was happening is where the exposure lives. Now, the structural close. What does the Lehman Repo 105 case establish about the mechanism as a matter of forensic finding rather than moral verdict? First, it establishes that a genuine accounting standard can be exploited to defeat its own purpose. SFS 140 was designed to distinguish sales from financings by asking who controlled the assets. The over-collateralization test was a real feature. Lehman crossed the threshold deliberately, posting excess collateral not because the economics required it, but because the excess collateral triggered sale treatment. The purpose of the test was to identify true transfers of control. Lehman satisfied the letter of the test while transferring no meaningful control at all, since it repurchased the securities within days. The lesson is structural. A rules-based test with a bright line threshold invites transactions engineered precisely to the threshold. Second, it establishes the vulnerability of point-in-time reporting. Lehman knew when the snapshot would be taken, so it could arrange its condition for that instant. The distortion was undetectable in the snapshot because it existed in the movement across the quarter, not at the reporting date. Any reporting system built on scheduled, known-in-advance measurement dates is exposed to this form of shaping. The measurement date is public. The behavior around it can be tailored. Third, it establishes the significance of the offshore opinion as a signal. The single most telling fact in the entire record is that the transactions were routed to London because no US firm would sign the true sale opinion. A firm's decision to seek a foreign legal opinion to support accounting for domestic transactions is, structurally, an acknowledgement that the treatment does not survive at home. That signal was available in principle to a diligent gatekeeper. It was not acted upon in real time. It was recovered only by an examiner with subpoena power after the collapse. The direct regulatory consequences followed. The FASB moved to tighten the accounting for repurchase agreements. Accounting standards. Update 2011-03 modified the criteria for determining whether a repo should be treated as a sale or a financing, removing the ability to achieve sale treatment through over-collateralization of the kind Repo 105 relied upon. The SEC enhanced its requirements for disclosure of repo activity, requiring firms to disclose information about the average and period-end levels of their short-term financings. So a quarter-end spike would be visible rather than hidden inside a single snapshot. That change addresses the exact gap the mechanism exploited. It forces the film, not just the photograph. The finding of this review is that Repo 105 was not an exotic instrument. It was an ordinary repo, over-collateralized to a threshold, executed offshore to obtain an opinion unavailable at home, timed to a known reporting date, sized at approximately $50 billion and undisclosed. Each element was individually explicable. Assembled, they moved $50 billion off the balance sheet at the moment the balance sheet was measured and reduced reported leverage by nearly 2 points for firms and markets that were watching that number above almost any other. The mechanism worked until an examiner with the power to compel the record reconstructed the movement the snapshot had concealed. The record shows what the technique was. The accounting standard that permitted it no longer exists in the form that permitted it.